Hey guys, happy Friday. This is Craig Modelmog. For this week's episode of Wall Street X's and O's for the week ending April 29th. It's crazy. It's hard to believe. I got a lot to cover today, so we're diving. We're doing a deep dive in quick. Here's my disclosure that talks about all the information that is believed to be true. I'm going to tell you that it is true. I am also going to tell you that this is not a solicitation to buy or sell anything. Investments can and will lose money. It's not investment advice, tax advice, legal advice. I have to put that out there. And without further ado, we're going to go. By the way, read all of this, clear down to the bottom, clear down to here, because you will be tested at the end. I'm joking. Lord, no, we're not doing any tests. I got a good show today. Top 3 things. Deglobalization. Is it political or economic? It is political, and I'm going to show you why. Income at last. This is good and bad. It's good because there's actually some yield out there. It's been very painful because bonds are one of the worst performing asset classes or categories out there on the planet. We're going to review the business cycle. I'm going to show you where I think we're sitting in or where we're fitting in this current business cycle. And I'm going to close it out with things that make you go, Deglobalization. Is it political? Yes. Here's why. If you look at all these things, Brexit in 2016, this is tariffs. We're going to do a T for tariff and a T for Trump in 2017. You got the rise of nationalism. This was not just in the United States. This was also in Europe. Look in China. China's really looking inwardly focused now, and they are shutting down everything. And that just continues to happen. We had the pandemic, which really forced that deglobalization. Again, that's not an economic thing. That was probably more act of God. I don't know, or it's just something strange. We've got Russia trying to expand and really look inwardly. They're trying to go out and conquer Ukraine right now, which is really not going that well. But again, not economically motivated or economically caused, I should say. Here's why. If you look at the deglobalization story count, which I underlined for you here, these are these blue lines. You can see how we've had these different periods of time where there's been all sorts of talk on deglobalization. Now, what the blue lines reflect, or what the orange line reflects, is world trade volume. It's the World Trade Volume Index, which measures world trade from a holistic standpoint. So it doesn't look at just one country. It's looking at the entire globe on what's going on from a trade standpoint. As you can see, we did see a little slowdown here for the pandemic. I'll put a P here for pandemic. But I mean, look at this. This is a massive bounce post-pandemic here. So we have not seen the world trade volume change as a result of the political moves to deglobalize. That's going to be interesting to watch, one that we are going to watch. Okay, moving on here. Top 3 things. Number 2, income. At last, I say, we have income. Yeah, we do. It's been painful, though. It's been super, super painful, people, because if you look at this, this gives you a first quarter view on what's happened with interest rates. This is time to maturity. So you have 1 month, 3, 6, 12 months, 2 years, 3, 5, 7, 10, 20, and 30. This is the amount of increase that we have seen in yields. This top one here, this is 1.69% increase. Okay, that is a double in yield, actually more than a double in 2-year yields. 3-year yields, this is incredible. What happens when interest rates are rising? You know what happens to the value of bonds? They go down. So for you bondholders, if you're a client of mine, guess what? We own bonds. Has it been painful? Yeah, it's been terrible. I look at it every day and it makes my stomach hurt, to be very candid with you. I will tell you this massive rise that we've seen in bonds could be in the process of topping out. I track it, the 30-year, the 10-year, and the 2-year every day. And I track the high and the low and what it closed at, because you can track the price movement, which gives you trend movement. Right now, we are in an uptrend in yields, in interest rates. They could be topping. I think they peaked on the 20th. We shall see, but it's looking like it did. We just have to be patient and see, though. So you got to hang in there with me. I know it's hard. We have to be patient. okay? Here's another good one. You see the current yield curve is the blue line. The yellow line was in December. The red line is 1 year ago. What do you see? I'm drawing these lines to show you the separation that we've seen from the blue line from December, which is 4 months ago, to a year ago, 12 months ago. This just shows the massive increase in rates. I mean, you look at this jump here. Look at this jump here. This is big. This is really big. I mean, it's just really, really big. I don't even know what else to say on that other than it's just huge. It's really huge. I'm erasing it because I don't like looking at it. It's painful. Here's what's interesting though. If you look back here, people, in 07, you remember 2007? This was the very beginning of the financial crisis. The blue lines here is the Fed funds rate. What did they do during the financial crisis? They cut rates basically back to zero, right down here. Okay. The blue line is the 10-year Treasury. So you can see here, this is 2.5%. I'm going to show you on the 10-year. So as they cut rates, 2-year went from 5 to 2.5. That's a decrease by 50%. Okay. Then as rates were at zero, they went from 2.5 where down to 1.5. Then we saw Fed Powell with great intentions here of raising rates clear until the very beginning of when? The end of 2018, beginning of 2019. What did he do again? He cut rates. What did he do? He cut rates again back to zero. What did the 2-year Treasury do? It proceeded to drop where? I mean, down to 0.5%. Now it's gone from 0.5% in 2020, which is the bottom of the pandemic, up here to just below 2.5%. These orange triangles are the Fed funds futures rate of what they think the Fed funds futures is going to look like at the end of 2022, in 2023, and in 2024. Here's what's interesting. I do not think that the Fed has more than 2 rate hikes in them. I just don't. I think they're going to get 2 more in. They're going to hike another 1%, which is going to get the Fed funds rate right up. Golly, so that was terrible. That was just terrible coloring there, wasn't it? They're going to get the Fed funds rate, and it's going to be right up around here. Okay, I'm going to change colors here. It's going to be right around here in this black, okay, in the red. All right. Here's what's going to happen. The economy is already decelerating, and I think what they're going to do is they're going to turn around and they may have to cut rates again. Well, anytime we get to a peak in interest rates hiking, what do bonds do? This is the 2-year yield again. They went from 3% over here down to 0.5%. That's why we have to hang on to bonds. You've got to hang in there with me. I know it's really, really hard. I was talking to a client earlier today. I said, don't look at your statements for a couple months. And they cracked up. And I appreciated their knowing I have a really warped sense of humor. But I'm like, there's better days coming. And I think we're getting close. Okay. Business cycle review here. This is good stuff. This goes through all the different ones: recovery, expansion, slowdown, recession. All right. I think we are somewhere in between these two. Here's why. If you look at during a slowdown, in each of these, it shows you what sectors tend to outperform. So in a slowdown, you get consumer staples, you get energy, okay, right here. You get healthcare, you get materials, you get tech. During a recession, what outperforms? Healthcare, utilities, consumer staples. Here's something interesting. In these 3 legs of the economic business cycle, you know what one thing is present, or one sector that outperforms in all 3 of them? Tech, tech, tech. Do you see tech over here? You don't. Okay. What is outperforming right now? Utilities and staples right now. Healthcare woke up as well. It's not outperforming yet, but it's been waking up. So we're seeing sector leadership like we would see in a recession, even though we are not in a recession. I repeat, we are not in a recession at this point in time. Some other interesting things that we see. During a slowdown, Fed becomes restrictive. You know what that means? That's called rate hikes. That's called the Fed is trying to slow the economy down. The Fed is trying to slow inflation down. That is just starting to happen. What happens again? Stocks peak, then fall. That is happening. What are we seeing here? Yield curve inverts. That has happened. Then it kind of went back to normal. It's very flat now, but that is starting to happen also. During a recession, Fed rate cuts. Are we in a Fed rate cutting environment? No, that is not happening. Long-term rates declining right now? No. Stocks fall through the expectations of a recovery. That is not happening. Economy contracts. That is beginning to happen. I think we're in the middle here somewhere because we're seeing some things that are present, guys, over here during a slowdown, and we're starting to see some things that are present during a recession. So we're going to keep talking about that, all right? But these are just kind of giving us an idea where, like I said, I really, really think we're somewhere in this middle, somewhere in the middle, okay? See how I can color that in now, just so nice, so beautiful, somewhere in the middle. Anyway, moving on. Things that make you go, this is good. Commodities are beginning to decline. Why do I say that? Well, here's why. I got to change the color of my pencil here. This, I'm going to call it, it's like brown colored here, is energy. We got a peak in energy. Okay. We have a peak in energy here. This is non-precious metals total return, peak. This next is ag, peak. What are we starting to see here? This trend is worth watching because here again, I'm talking policy here. I've been talking about this for weeks now. Here's what I think is going to happen. I think we're going to see the Fed raise rates into an economy that's already decelerating, into an inflationary environment that is starting to decelerate. Okay, it is going to put the brakes on the economy, and you're going to see also inflation remain stubbornly high. It's not going to go back to 2% or less, which is their target. It's going to stay higher, but it is starting to drop. Okay, so we have to keep our eyes on this. This is one of those things that makes me go, I measure and map it every single day. Moving on. S&P 500 performance. If you look at over here, these 5 companies account for 25% of the S&P. All right. If you go over to my little graph here, the dark line is the performance of these 5. Okay. It's very good. If you look at the blue line, which I'm going to get a blue color out here now. The dark blue line is the performance of the S&P minus these 5 over here. Okay. It's underperformed, the S&P. If you look at the performance of the S&P, which is the faint line, it's this one. You can see how the S&P peaked here. It bottomed here, but you can see big peak on the performance of these big 5, Facebook, Apple, Alphabet is Google, Amazon, and Microsoft. Here's my concern. This here, people, and this is, again, it's what keeps me up at night. This gap here is concerning. You've got 5 companies that everybody on the planet owns, whether it's individual investor, institutions, mutual funds, hedge funds, etc. If we enter into a period of time where I get concerned about market volatility continue to rise and stay elevated, this is a lot of room to pull back. And I really get concerned about that. We got to keep our eyes on that. All right. We got to keep our eyes on it. If you own those companies, just be prepared. All right. They've already had some pretty tough days. I mean, Alphabet is down almost 50%. Amazon was getting hammered today. Microsoft was getting hammered today. Facebook is gotten smoked this year, although it was up real big yesterday. Apple's been the only one that's held up. So here is what you can do for me. Watch Apple. The second you start to see Apple really start to decelerate and really start to lose value, and what I say by that is drop below, I was going to say 160, and Apple's trading at 158 right now. Drop below 150. I would say right here, if we drop below 155 on Apple, hang on. All right, hang on. That's all I'm going to say. Last slide here. Are equities a good hedge against inflation? Historically, yes. If you look at this, this is annualized returns from 1970 to 2021. And this is the dark one. The dark column is stocks. The gold column is gold. The blue column is bonds. And this light column is cash. This is after inflation. Right now we're running obviously peak inflation, so your total return is 11%. Actually, it's lower than this right now. This is average inflation, so it is correct here. So if you see it, you've got 11.06. If you do that minus inflation, it drops you down to 6.87. That's going back 50 years. So your total return on equities has been 6.87. Your total return on gold has been 3.82, bonds 2.77, and cash is 0.5%. At the end of the day, it still behooves you to own stocks. Although there are periods of time when it is hard to own stocks, much like now. So if you are a conservative investor, if you are a retiree right now and you own equities, you have to keep owning them. It is just painful at the moment. You've got to hang in there. Really focus on a couple things. Focus on, if you're pulling money out, focus on your withdrawal rate. Are you pulling out more than you need? If not, you may want to cut back a little bit. Outside of that, you have to be patient and endure these troughs in the economy and in the equity market like we're experiencing now, because that's the only way you're going to get through it. The only way you're going to get through it, guys. But anyway, hang in there. So are equities still the place to be? The big question is yes. Yes, it is. Always buy stocks and own stocks. Thank you. You guys are wonderful. I appreciate you guys. It's been a busy week. I'm excited. We're almost into May. Hopefully May brings some showers because we need some here. But anyway, again, Craig Modelmog, Wall Street's X's and O's for the week ending April 29th. It's always a pleasure. I love you guys. Thank you for your time. If you need anything, obviously let me know. Outside of that, have a fantastic Friday, and I am